We are live, Joe. Your camera is off, sir.
And I'm back.
Hello.
Hey, buddy.
Yeah, pretty excited about that idea we discussed this morning. So,
oh hell yeah! No, I mean that's just mind blowing.
Yeah,
I was waiting for that, because I think that partner is key to advancing all the other stuff.
Yeah,
the TradeFi folk stuff.
Yeah,
because it validates.
Yep.
So super cool. Oh, hey,
super cool.
Hey, everybody.
Hey, everybody. You didn't know we were live?
No, I wasn't. I just forget half the time. I'm live 24/7, 365. So sometimes I'm just broadcasting to myself. But
oh, that's funny as shit. All right, so posted a new episode of Mission DeFi today with Toshi from Ethos or Ethereans. Really fascinating model. They started 4 years ago building this thing. He paid for most of it himself and then built a self-sustaining yield model for members to earn, but also for the project to earn. Anyway, the entire concept behind this is they've built, it's pretty complex. And I think I'm going to have another interview with them to go a little more granular on it. But essentially, it is there are 4 components to the system, but it allows developers to utilize existing modules for Ethereum development that are tested, secure, safe, and build on top of instead of building from scratch or copy pasting, existing shit that's full of security holes. So it has some pretty unique granular governance model capabilities as well as sub-DAO capabilities. Just a system to make it faster and easier to develop, make it safer for users and developers. It isolates functionality and almost like sandbox isn't the right word, but that's all I can think of at the moment. So that even if there are potentially exploits or hacks, it isolates from some components that might allow someone to steal even more. So anyway, really cool model. This guy Toshi is Alessandro Toshi is just brilliant Italian guy, but just impressive group. Impressive that they've really just built this on their own dime. Team of 15 over all these years, and they're very close now to popping it out there and see how it does. So anyway, if you get a chance, everybody take a look at it at missiondefi.com. So
cool.
Very cool. You want to talk about CZ a little bit?
Yeah, let's do CZ and his Twitter play.
Yeah, man. 500 million. I'd rather it be 50% CZ, 50% Elon would be my preference.
Yeah, I'd like to see, I think who's backing Elon again? It's Morgan. I think it's Morgan
Tesla.
Tesla, yeah, Tesla. But I think that they've got, if I'm not mistaken, I think Morgan Stanley is the one that put up 25B of that money, and there's another one of like 13 million coming from another bank. So yeah, I'd like to see more like Binance's and crypto.coms and FTX's in this and the CZ play than TradeFi folk.
Yeah.
But, at least he's getting his toe in there.
Yeah. What were you saying earlier about where the money came from?
Yeah. I just say, fire up the printers. Let's get some BUSD going and go get that shit for free.
Exactly.
Yeah. So, that's what I think is just funny. Somebody was cracking jokes about that. I'm pretty sure he's funding with fiat or BTC or something. But still, it'd be funny as hell. It's like USDT going.
Yeah, absolutely.
They announce a big. They're going to buy Twitter, man. They're printing 50 billion.
Exactly. cracks me up.
Yeah.
So Yearn version 3 is coming, and this embodies not only a lot of new functionality and features, but number one, it allows for what they're calling junior tranches or vaults that allow people to set up higher risk plays than the typical highly conservative Yearn plays. So you've got a fairly secure existing infrastructure where you can now actually set up vaults that are higher yield in higher plays. I'm assuming there's some kind of whitelisting or pre-approval, but anyway, they've moved to 100% to, or mostly to Solidity and off of Viper, but people will still be able to use their existing modules. But this is the thing I'm excited about is the Vault standardized Vault tokens with ERC 4626. And that's the Vault standard that Joey Santoro and a bunch of other people have built together to make vaults far more secure, tokenized, contain all the functionality of the vault in the token. Just makes for a better, all the way around system. So I'm pretty excited about this, and I'm excited to see some higher yields in Yearn. So looking forward to that launching. I don't think they give us a timeline here. Let me see. Modularization of the system, composable yield-bearing tokens, and a more accessible programming language, so more developers can develop on it. People that are Solidity developers can now develop strategies on it. So anyway, it's exciting to see that they're doing this upgrade, and I'm really excited about seeing the 4626 implementation in real life. So that to me is exciting.
Yeah, I'm excited to see that too, because we haven't had a token standard around specifically designed for this space. And so to me, I think that's going to be pretty cool to see how people use it.
Well, and from our own benefit, the composability of this means it makes it much easier to make use of your vaults. Right now, it's very. I was talking to Scoopy the other night. They have
Scoopy of Alchemix.
Yeah, sorry, the Scoopy of Alchemix. They have.
I guess he's the only one we know. So it's like, sorry.
How many Scoopies do you know, really?
Yeah.
But others may not know. They have multiple layers of smart contracts that have to interact with the existing Yearn system, right? And Yearn is a critical component of the payback mechanism for Alchemix on those loans. So they now can eliminate all of that overhead and all of that code that is an attack vector and utilize these composable tokens. So now that dramatically streamlines their development, reduces the amount of developer hours they have to put in and number of developers they're going to need. And the higher yields will allow Alchemix to do some of the higher yield, riskier vaults that they were going to offer to people for paybacks on the loans. So all in all, I think this is a really good thing. It's going to mean that Yearn has a lot more opportunities for integrations. It's going to make it easier for other projects to integrate with them. So I think it's a really awesome move. And I'm really hoping more and more projects embrace the 4626 standard, because I think it's going to make things a lot safer and easier. So,
well, you look at like Yearn and you look at Curve, and, those are, I have a hard enough time understanding what's going on there, the real complex stuff. And I can just see people that know nothing about this rolling into the space, and they're going to be so confused. I hope this simplifies onboarding sort of normies or newies or trade types into the space, or just, BTC maxis that want to explore DeFi, but don't want to, be thinking through all the risk.
Yeah, absolutely. Absolutely. Alchemix is now live on Phantom. So that is up and running. Spooky, Spirit Swap. I'm excited about it because, I'm a Alchemix and a Phantom fanboy. So, the bridge is set up. People can move their tokens in. They can, start utilizing swaps, etc. Now, let me see if the rates are still the same. Earlier, I was looking at the LUSD. LUSD pools on Spirit Swap. If they're Sidle load.
Spirit Swap, Spirit.io?
No, .finance. There we go. And we go to farms. And we go to GALCX. Currently, an APR in a GALCX WFTM pool of 329% to 819%.
Wow.
It started off at about 3,000 last night, but obviously people have piled in. But there's only 12 grand in there right now. But that includes awards are paid in, I believe. Let me see.
That token, Spirit token, is only 3.6 cents right now.
I guess. I don't know.
Damn.
But rewards are paid in
Right.
Spirit and paid in GLCX, I believe, is the model, but not confident on that. But that's a sweet return for Alchemix holders. Like that's
Is that
pretty
in the
awesome.
what page? That's Farms. Okay.
Farms.
I'm just on it too. I was looking at it.
Yeah, just do a search on GLCX.
Look, and I've been up and down in Spirit a couple of times.
Yeah.
I mean, when stuff rallies, that thing easily goes into the 30s and 40s.
Oh yeah.
I mean, at 3.5 cents, 3.6 cents, that's I might be getting some of that.
Yeah.
Okay, so Spirit FTM, Frax FTM, 20% roughly. You can boost to 30. Now, where is Alchemix? Is it toward the bottom?
Just do a search on the top right for GALCX.
Oh, there we go. I see GALCX. Is that the one?
Yep.
Yeah. Fudge. You can boost that to 820%.
Exactly.
Yeah, that's nice. And remember, these have no deposit fees.
Yep.
I don't know if they have a fee on exit though. I can't remember, but it's diminuous if there is one.
Yeah.
That's a nice. They also have a GOM FTM pool there. I didn't know about. That's only nice.
Oh no, it was Beats that has the ALUSD. That's what it was. Beats. Beethoven's also launched with ALUSD, so stable farm. And let me pull that one.
Yeah,
up.
I'm so glad to see them over here.
Me too, man. I think it's going to do big things for them. I retweeted my use cases tweet today as well. So,
hey, were they originally? They were originally on Ethereum. They never went to Polygon, right?
Yeah. So this is a combo Yearn Vault and ALUSD, their stablecoin, currently paying 61.29%. So basically Yearn and DAI, I think it's Yearn DAI and something else in the Yearn token and ALUSD. So basically pretty steady and strong pairs for paying 61.29% on Beats.
Wow.
Yeah.
Yeah, I've always you turned me on to Alchemix and I've just always wondered. I mean, I love the model. Right. I just love. I mean, I was reading. We're going to talk about that article maybe later on. We got a guest coming on in about 5 minutes. But
oh yeah, everybody, we have a really cool guest. One of Joe's government econ buddies is coming on to talk
about tapering, quantitative tightening. What we talked about a little bit yesterday, I think.
Are we going to get in the deep state stuff too?
I knew you were going to pull that one out. No, he's got a couple of master's degrees and has worked in, he was did a stint in the Ministry of Finance in Japan.
Yeah.
And he's been deep in, Treasury and did a lot with the Pacific Trade Treaty or whatever, the one that was nixed, I think, when Trump was elected. He was one of the big drivers there and known the guy for a long time, super smart. And I talked to him yesterday and I said, look, I keep trying to explain this quantitative tightening thing, like what happens to the assets on the Fed balance sheet and how does it affect consumer spending? I said, could you come on and just explain it? Because it almost makes me feel dyslexic when I'm thinking through it. And he was like, yeah, absolutely. So, but he won't be doing any official government policy stuff. It's just going to be more of like economics professor stuff.
Okay.
But I can't.
So no official word from the Biden administration through him.
No.
Okay.
This is just we're just going to talk about how it works, the macro stuff.
Yeah.
But there was something else I was just thinking of was with Alchemix. Yeah, I was like with them. What's interesting is I was tying it to the Sailor thing and his margin. Oh yeah, so we're going to talk about this later, but his Bitcoin loan from Silvergate is a 25% LTV. So if Bitcoin drops, I think to 21,000, it goes to 50% LTV, and he has to post some more uncollateralized BTC to cover the movement. And you start thinking about stuff like that, and you go, okay, you're only getting 25% LTV from Silvergate. Why aren't you going to something like Aave or Alchemix and go park that $500 million, or I think he's got a couple billion of it, but let's just say a couple $100 million, park it there and borrow at 85% LTV.
Right.
Buy more. I mean, so I think that, and then with Alchemix, of course, you don't have to pay the loan back.
Right.
So to me, I'm just surprised more corporates haven't, jumped onto that or more investment houses. Maybe they have.
Maybe they have. There's a lot in there. There's a shit ton in there.
maybe that's something that we can bring some people to Alchemix for that.
Absolutely. I'm excited about that, buddy.
Yeah. What's their TVL right now?
I don't know. Let's see.
Oh, there he is, looking all
Did
in
he
the
get
green
dressed
room,
up?
looking all economic professor-ish. So
Excellent. Well, we definitely want that. You want me to add him in? You ready?
yeah, let's add him in, man.
All right. Welcome,
Okay.
Gavin.
Hey, is my mic working?
Your
You're
mic's
working great, man.
You look good.
Okay.
Oh, I
Cool.
see you
What's up, guys?
put on a collared shirt today, huh?
Not for you guys. I had a previous Zoom.
got
Got out of the sweat.
paying client, right?
Took the tie off. Wanted to relax it up for the crypto guys.
You got it.
Nice to meet you, Gavin. Thanks for coming on, man.
Yeah, nice meeting you guys. You know what? This thing did the die. Wait a second. Let me go. I think this is better.
It's working fine on this end.
Yeah.
So we can
you hear us?
Yeah. Are you hearing me now? This
Yep.
is weird. Whatever.
Absolutely.
Okay. Let's just go with this.
Great.
Yeah, so I told everybody that we're bringing you on because I always try to explain the quantitative tightening or tapering and where the money goes and how it works. And I always get lost in kind of a dyslexic loop at that point. I've always had trouble just doing bond-related stuff because it goes counter to what I feel like it should be. And so I get lost in that. So I thought it'd be good to bring you on with your double master's degrees in finance and econ and sort of explain it to us and our listeners and how that affects, both consumer demand and, overall macroeconomic situation in the U.S.
Right. Okay. Yeah. So I'll just do a quick macro overview and then you guys can ask questions. How about that?
Sounds perfect.
Right. So, Fed raised rates 50 basis points. And what that means is that they raised the overnight repo rate and the Fed funds rate, which are basically the same thing, 50 basis points from 0.25, annualized to 0.75. I'm pretty sure is where they went. And sure I'm doing this right. And in addition, Powell said that they were going to start rolling initially 50 billion a month off the Fed's balance sheet. And ultimately, they were going to be looking to rolling 100 a month off the balance sheet. Now, if you guys remember, right before COVID, they also started a interest rate normalization and a balance sheet shrinking. But then COVID came along and they kind of reversed course. So, and then of course, the equity markets responded favorably because they had kind of priced in a expectation that there might be a 0.75% rate hike. And in addition, Powell said looking forward that there could be another couple of half-point hikes, but he kind of was a little bit dovish with going with more than that, right? So we have inflation. It's running annualized about 5.2, which is the highest it's been, for like 10 years. And it's mostly, kind of demand-driven inflation. And this is a function of the relatively lax monetary policy, but also, going back to the previous administration, there's been a lot of economic stimulus pushed out into the economy, right? You have the previous administration's tax cut that was good for about $1 trillion. Then in March, right when COVID hit, they did a 2.2 trillion stimulus package. That's a lot of coin. Mm-hmm. Then December of that year, they added another 1.9, and then Biden came in in the December of that year, they did like 900 billion. And then Biden came in and did a 1.9 trillion. So, $23 trillion economy. These are substantial stimulus packages, as like Larry Summers, who was previously Secretary of the Treasury and, you know, all around good economist. He's like, these are levels of stimulus we haven't seen since World War II. So really big packages. And so for the Fed, I mean, they're trying to, in a sense, offset that because there's all this stimulus coming on. The economy is really running at max capacity. You know, unemployment's 3%, which is low. It's like that's down towards the kind of, you know, low boundary of unemployment. All this talk about supply chain disruptions. I mean, that's just another way of saying that you're running the engine, you know, at max capacity, and of course you're going to end up with, like, you know, supply constraints here and there, right? I mean, you're going to run out of chips because you're making too much stuff that makes chips, right?
Right.
I mean, yeah. So the Fed's problem here is they're kind of like skeet shooting. They're trying to lead a moving target because you have all the stimulus that's coming on that is, you know, just pushing more gas into the engine and revving the engine higher. And then the Fed's trying to, like, with monetary policy, keep it down. I mean, it's a tough road. So I'll stop there for a second.
So full employment is traditionally 4%, right? Right around there.
I mean, who knows? Because, you know, there's a question of whether or not people have left the workforce permanently or temporarily as a result of COVID. But yeah, I would say that you know, the natural rate of unemployment, or whatever we're calling it these days, is, you know, 3.5, maybe 4. But it's definitely, and you see that, you know, you can see that in wage price increases, right? Again, these are all symptomatics of an economy that is kind of at max capacity. And, you know, imports, physical imports take up a lot of the slack. But, you know, I mean, inflation is what you get when you have demand exceed supply.
So the RPMs are revving high, and it's time to shift.
Yeah.
Okay, so the last time they went on an upward rate cycle, previous administration, was it 2018-ish, when they got it up to I don't know what, 2 or something like that, but then they started winding down, or I don't know if they actually got into retiring stuff off of the Fed balance sheet at that point. I think they did, but I'm not 100% sure. And then all of a sudden they had to reverse course because that double whammy was kind of tanking the stock market too much for what the previous administration was willing to tolerate. What do you see happening this time around when they start retiring, you know, $50 to $100 billion a month on top of raising rates?
Yeah, I mean, there's a whole bunch going on there. So, you know, so the Fed tries to implement its monetary policy 2 ways, right? First is just by setting those overnight rates. It does that by fiat and says, you know, basically this is what, when banks come to us for money overnight, this is the price. And they just set that by fiat. And then there's the question of, like, remember they were doing this quantitative easing where they were basically saying, we're just going to, like, expand the Fed's balance sheet, which is synonymous with increased money supply, right? Because on one side of the balance sheet, they're going to have securities, marketable securities. And on the other side of the balance sheet is money, M1. So if they want to expand the money supply, they basically buy marketable securities from the market in exchange for money. And so that drives down interest rates, increases the money supply. So now they're doing the opposite. And they're going to try and contract the money supply and push up interest rates, along with doing the kind of just by fiat saying the overnight rate is going to go up a half point.
Okay.
So, yeah. I mean, I'm like looking on the Fed's website now, you know, so where were they? We've been since March of last year, the overnight rates basically between 0 and 0.25. And then March 17th of this year, they did a quarter point hike and then did a 50-point hike. So right now they are targeting an overnight rate of 0.75 to 1%. That's, annualized, right? Last time it was in that range was again like March of 2020. And then if you go back to like 2018, 2019, we were in the 2.5% range. So, they're normalizing, I think, interest rates, but we're nowhere near like high interest rates, right? Yeah. Nowhere near.
So when the Fed like reduces the balance sheet and I guess retires those securities, how does that work?
It's not retiring those securities. What it's doing is essentially selling those securities back into the market.
Okay.
And that takes money out of the market. It takes cash off banks' balance sheets. So that cash that banks don't have available to lend. Mm-hmm. So, there's the reserve requirement and it's fractional banking. So if you take cash out of a bank, there's a multiplier effect to the amount they can lend. So it's taking cash out of the system, which then has a multiplier effect in terms of cash available to lend.
Okay. So then that makes interest rates go up since there's less cash, or households would pay more, say, for consumer credit or for mortgages.
Yeah, you're again, part of the Fed's problem is that they can only really affect the short end of the yield curve. And so because the long end of the yield curve, right, when you get out 5-10%, that's interest rates out there are largely a function of expectations, right? So it's like I go to Joe and I say, well, what do you need to lend me money for 10 years? And Joe thinks to myself, well, I know what the overnight rate is. I know what this is. I'm projecting what I think inflation is going to be 8 years from now, right? Mm-hmm. And so this is part of the Fed's task is they have to control inflation expectations, which is really why they don't want this to get away from them, right? We don't want to go back to like the 70s and early 80s, mm-hmm. where Volcker was like slapping on 18% interest rates to try and crack inflation, right? You can't. This is the Fed's whole thing. You can't let inflation get away from you, because then you got to slam the brakes on hard. So they're trying to do a little. I read this one article said they're trying to do the Goldilocks, just not too much, not too little, just right. But it's again, because you've got all this stimulus coming on, so then you're kind of leading that target, and then you got to decide, well, it's really expectations that I'm trying to affect, and that's kind of tough to quantitatively determine what it is,
right?
And so they're kind of dabbing the brakes, and going to see what happens, but and they're signaling to the market that this is where we're going, because signaling is really important, because that's what controls those expectations, market signals, which is why everybody always reads like the Fed statement, and Greenspan, when he was the guy famously would like mumble and say like stuff, and people were like, well, what's that going to mean, but that was all like his way of saying to the market, well, I don't want to signal too much, or I want to signal this, but again, you're trying to control the expectations, which are really what affects the long end of the yield curve.
Mm-hmm. Interesting. Yeah, that old premise of mine in consulting, high expectations, low satisfaction. Low expectations, high satisfaction.
Right. They got a tough job, mm-hmm. because again, there's all that stimulus coming on, and when they do those stimulus packages, that 2.2 billion from 2 years ago, like during March of the initial COVID, a lot of that money's still coming out, right? A lot of that was spent. Yeah, we paid paid a lot of people not to go to work, right? So
Right.
that money's like
Gone.
under the bridge, down the river, out to sea.
Yeah.
But there's like a lot of money, I mean, infrastructure projects, that stuff doesn't hit for like years, right?
Yeah, right.
Yeah, I didn't think of that.
I hadn't thought about the infrastructure money at all, but that definitely has an impact. You listen to people out in the crypto world, and a lot of them are saying, that you're talking about how difficult it is, this job that they have to do, and how tough it is to set expectations. I think a lot of people in the market are thinking that, we're too far gone, and I have no expertise to gauge that or not, but that we're going to have to end up with like, forced recession, Volcker kind of stuff, in order to reset everything. Do you have the feeling that we are reaching that point, or do you think there's still time for them to continue tapping the brakes while sliding on the ice?
I mean, it's 5% annualized, which is not crazy bad. A lot of that, I mean, is energy prices, right?
Mm-hmm.
And that's, that's cost plus inflation. So that's different from the kind of too much demand for the engine to supply, right?
Right.
That's, that's just Russia, right?
Mm-hmm.
And Ukraine.
Right.
I mean, so
Right.
there's that kind of stuff. And I think the Fed would discount that, because that's not like, that's not a function of economic policy. And I mean, they're going to have to counter that in a certain way, and it certainly adds to inflation, but it's not the too much demand inflation, right? So
Right.
we can kind of discount that a little bit. I mean, and then there's going to be food price hikes coming, because you take Russia and the Ukraine out of the food supply, and that has an impact.
Yeah.
And again, that's kind of restricting supply. I think that there is this kind of hope that that, and then there's China, right?
Mm-hmm.
We get a lot of supply from China, and China is still in lockdown.
Right.
So
that's something we don't talk a lot about, is what's going on in China these days. Just Shanghai shut down, Beijing almost shut down, Shandong shut down. I mean, iPhone City shut down.
Yeah.
I mean, that's big.
It is big. I mean, China, the story of the last 20 years is, or part of the story of the last 20 years is the increasing importance of China to the world economy, and, it is, second or third largest economy, depending on how you want to count Europe. And yeah, I mean, if they're and they already were in trouble, right? Because we knew the property sector there was going to hell. And so they've always had kind of loan loss issues, because there's complete lack of any kind of financial transparency there. But yeah, the shutdown there, I mean, that's also another headwind, right? I mean, this is the problem. It's like, yeah, we're coming out of COVID, and everybody's going back to work, and there is full employment. That stuff's all great. GDP growth is pretty good, as you would expect, right? Coming out of COVID with all of this stimulus, these ultra low interest rates. I mean, that's why we have good GDP growth, why we have low. And the question is, can you chart that course? Going to your point, I mean, this is certainly what they're trying to do, or are they going to achieve it? I don't know. Who's got a crystal ball? Yeah.
Well, I always say it's good to be in dollars. I mean, unless you're in crypto at this point, but because that's the last one standing at the end.
Well, it is. I mean, it's like another friend of mine called Joe was like, he called me up and he was like, "Oh, what should I do with my money?" I'm like, "Well, you don't really have that many options, buddy.
Mm-hmm.
You can't put it in bonds, because we know that's the wrong answer. I wouldn't put it in foreign currency because that ain't a good answer.
Mhm.
I mean, you're kind of stuck with equities because at least there's an inflation, built-in inflation hedge there. And then I mean, your guys, the crypto sector. I mean, the reality is that they haven't really gone through a full business cycle. So we don't know what as a class what the asset will do, right?
Right.
I mean, we don't know. We don't know what the correlation coefficient to the S&P 500 over the course of a full business cycle going through a bull a bear market and out the other end, which is
An uncertainty.
Yeah.
Yeah. Yeah, that's true because it's only been around since 2008, 2009 stimulus packages or 2010, whenever. I can't remember when all those rolled out in the Great Recession, but it's only been going since then, and it's been up only basically. And
it's been up only. I mean, you guys know this more than me. I mean, I think it's been a little sideways for probably the last 9 months
6
or
months.
so.
Yeah.
Yeah.
Since November-ish, November 9th,
Yeah.
I think it peaked, but yeah.
Well, yeah. And it, like I said, it is as an asset class, like not even getting into the differences between your various coins or whatnot. It is kind of untested because, even Bitcoin's been around since 2008, but I mean, it hasn't really been a thing.
Right. There hasn't been the substantial amounts of money yet.
Exactly.
Yeah.
And even then, I mean, really, crypto as an asset class is still just a fraction of what you see in your kind of equity bond assets, right?
Right.
Mm-hmm.
And so, but look, the tide was in, the tide's going out. When the tide goes out, it's like I was reading an article about the Lake Mead, and it's like falling, and there are all these bodies that they're finding, like in oil drums.
Yeah.
Yeah, man. When the tide goes out, all those dead bodies come out.
That's awesome.
That's funny, man. Yeah, it's going to be interesting to see what happens. I mean, everybody's, it's hard. I mean, I kind of want to see a big capitulation wick down in crypto, just so that people then reset and start buying. Because, everything we see is so much institutional money's in there now on top of retail. And institutional doesn't always sell. A lot of times they might trade, but they want to drive it down and buy more and then ride up, just like any good trader of anything does. But we don't know where those numbers are. And I think we hit 28.5 last June. And, I'm kind of thinking it's somewhere between 25 and 28. If, whereas I saw everything was kind of going down today, but it seems to have stabilized. The BTC has. But the stock markets were getting pretty much gutted today or this morning. So,
is that right?
Yeah, it was all down. Let me pull it up right now.
Well, they had a big day yesterday. So, they gave a little bit back. Let me see.
Yeah, a lot of it was off like 5%.
Oh, geez.
Well, that was earlier.
S&P down 3.4.
Yeah. So, but it's kind of come back a little bit.
That's kind of weird.
Yeah, I think
NASDAQ down 5%. Weird. Huh.
Yeah, I think it's like you said, it had the big run, and everybody's like, okay, now we'll just
only
trim
3.
it.
Yeah, I don't know.
I mean, the reason. Go ahead.
Yeah, I was just going to say something else to think about is, if how much margin is floating around in crypto, because if it is an asset that has a lot of, holdings are margined, as that margin gets more expensive, which is what's going to happen when interest rates go up, right? I mean, it's going to be more expensive to hold that position that is margined. You'll just naturally see people selling. So if there is a section of crypto that is heavily margined, I would expect that would probably see selling.
Yeah.
Yeah,
No,
some cascading liquidations probably as well.
Yeah, and a lot of the platforms where you can stake and borrow against, they have LTV, say BTC or ETH in the 70 to 85% range. But then we were talking earlier about like MicroStrategy's loan for BTC is at the 25% LTV range. So that's kind of reasonable in my mind, but everybody else that's levered up at 85% and then parks that, it's not like they always just they don't convert it to dollars. They go stake it somewhere else in stable coins or whatever to get yield, or buy more of the underlying asset and do these kind of spirals. Any big volatility there is going to could have cascading liquidation.
Yeah. And look, I don't know how sophisticated positions that people put on in crypto are, but in like traditional markets, you can do straddles. You can take positions in which, if you know the relationship between the asset classes, you can offset your risk in one asset class by taking a position in another asset class. So, and the exchanges will let you do that to a certain extent, which kind of reduces your overall margin requirement, but it requires kind of a better sense of what the historical relationship between certain assets are. And I don't know, in the world of crypto, if people have imported those trading strategies, but without the historical data underneath it, that you can make those trade-off decisions. You see what I'm saying? So, and so I would think, because it's such a new asset class, that you might get market dislocations, in one particular, crypto category or something, that would then, like you said, have a cascading effect. And I mean, I'm not quite sure what the volatility is, but I don't know if just a 50% loan to value it is enough.
Yeah.
Just
right.
I'd say volatility is high. Volatility is high, very high.
Yeah, absolutely.
Yeah.
No, that's easy to hit with crypto. And now we have, now with multiple chains, we have more sizable assets that are critical to funding a lot of other things within a given chain. So for example, on the chain called Phantom, the token of that chain is FTM. So a lot of things are paired with, borrowed against, etc. That particular token. And it already had liquidations last week on some large sell-offs. So I think we also have a cascading liquidation effect, but we have so many interlinked things within this market that it becomes even riskier, because the interlinking happens and there's no way to kind of track them all the way across chains and protocols within the system. So you just never know when those dominoes are going to fall across the board.
Yeah. I mean, that's kind of the exchange's job, because ultimately, if there is one of those cascading liquidity events, it is going to be centered on the exchange, right? I mean, if stuff starts moving fast, and this is something that crypto is supposed to solve for, right? Is that you don't have settlement risk, right? That you don't have transaction risk, because it's supposed to be kind of instantaneous settlement, instantaneous transaction. It's not like, equity markets where it's T plus a day for settlement, right? So you got like 24-hour settlement risk there that, things can happen. And then, who owns that dead baby or whatever it is, right?
Right. Yeah.
Yeah, that's true. And it's instant in crypto. And also with crypto, when you talk about trying to hedge or go across other asset categories, in everybody's mind here, it's like, BTC and stable coins, or ETH and stable coins, or yield farming and BTC, all in the same asset class, really. Nobody's doing anything like, if crypto goes down, what goes up, because there isn't that data.
I was reading that there is kind of so crypto is crypto. It's it's run on the blockchain, all this kind of stuff. But there's kind of offshoots. So like if you pledge your crypto to someone, and then they are doing something that crypto, you haven't changed the chain such that it reflects the fact the ownership of the crypto hasn't changed from me to whoever I've pledged it to.
Right.
But the person who I've pledged it to is then using it. So in that kind of scenario, which I don't know how frequent that is, but you're reintroducing all of those settlement risks and transaction risks that crypto was designed to avoid. You see what I'm saying?
So you're more accelerating the risk by the fact that you're parking it in multiple protocols going forward.
Yeah.
So if anyone,
yeah, and maybe the underlying blockchain doesn't reflect these multiple kind of almost ownership liens on the asset.
Yeah. I mean, those are controlled for the most part by code, but I think the underlying message that you're getting across there makes sense. The risk is increased because, number one, there are things that people could be doing with that asset in another contract that actually increases the risk or the leverage on it. And number two, unwinding things is a multi-step process. So you have gone back to kind of this delayed function of it. And then the other thing that happens is when you have massive activity on chain because everyone's trying to get out at the same time, it then clogs up the chain and dramatically increases fees, which causes people to sell more things to make sure they can have enough fees in the system, and slows down the ability for people to unwind and get out of things. So they're just dumping as fast as they can everything they have. And that is, certainly increases the risk. I know you have another call, but I was curious, in your circles of folks, what do you have a sense of kind of the general sentiment about crypto? Do you feel like people that are, with your level of expertise and in your world are actually seeing it as having potential? Do they kind of think it's a fly by night? What's kind of
your
reaction?
I mean, everybody recognizes, I think crypto is here to stay. There hasn't been thus far kind of a blockbuster application for crypto,
right.
and I think we can agree to that. I mean, there's been a lot of things floated, but it's not immediately apparent, or it hasn't come across thus far yet where there is an application for crypto for blockchain that clearly solves a problem and does it in a way that generates economic rents. I mean, there's the whole thing. Crypto as an asset class, it's a digital bar of gold. Fine, great. But part of the whole promise of crypto was that it was this new way. It's a distributed ledger. It's a new way to solve problems, and I don't think that has come forward yet. And that's what a lot of people talk about, because as long as we're talking about non-fungible tokens of Kobe Bryant dunking a basketball, right? I mean, if somebody wants to pay $200,000 for that, go for it, right? I mean, but that's not like a public policy thing. That's just a choice that some guy makes to buy the thing, right? But and by it's self-limiting by its very nature, right? I mean, there can't be that many people out there who think it's a good idea to buy an NFT of Kobe dunking for $200,000, right? And so maybe absent that
killer app,
or that, then it's going to be relegated to kind of a curio. It's going to be an asset class that could be a store. I mean, maybe it's a store of value. People see it as that. It is that, right? I mean, it's like a Chevy Nova SS from the 1970s. Yeah, it has value, but you're not gonna make your financial system base your financial system on 1970s muscle cars.
That's really interesting, and I'd be curious, Joe, if we got a room full of folks kind of and I think that's I think your opinion is valid about what kind of generally people in that world think about it. I think that's absolutely valid. I'm curious, Joe, if there was a room full of those folks that were walked through a lot of the applications in DeFi, what the reaction would be, whether it would be, you're just recreating our models just easier and without permissions, or if it's more along the lines of, oh shit, I didn't know they were doing that, because I mean, getting exposure to what's happening in DeFi in terms of the applications out there. And I agree, there's nothing that's been like, oh my God, the real world must have this today, right? At all. But I wonder if there would be a change of opinions, or if people would still be like, yeah, well, great. You're just making it a little easier for me to get to it.
I mean, again, maybe it's one of those things that it has to mature a little bit more before those applications develop. But I mean, just think about it. I mean, think about like tech change in the last 20 years. Think about what you can do on a phone nowadays. Think about Netflix. Think about these killer apps that have fundamentally, changed a sector of the economy. And you can't say that about crypto, right? I mean, there's like a lot of hype about how it's going to kind of fundamentally change, finance as we know it, but no, it hasn't, right?
That's right. Yeah, absolutely. Yeah. That's the reality. For most folks, it definitely hasn't.
It's sort of like the .com days when, I always draw the analog of, when I was working for a couple of those pets related companies, and there was like 6 companies with 50 million from VCs competing to see who could ship more 50-pound bags of dog food through the U.S. mail service, and pay for shipping. So, but what came out of it was, well, in that space, not a lot, but in other spaces, think about fiber. Remember they pulled all that fiber around DC, it was Quest and Global Crossing and everybody else. And they built it all, .com crashes, and everybody's like, what the hell are we going to do with this fiber? It's all at like 1% capacity. And then came YouTube and FaceTime and smartphones and, used it all up for these apps that people weren't really thinking about. So I agree, it hasn't quite happened yet. But when you go to the edge in like DeFi and other areas, there is some pretty cool stuff going on. That is people trying to figure out that they haven't solved it, but they're all kind of taking capital and working that direction. So I think we're probably still 2 years out on that, maybe. Brad, what do you think?
Yeah, I would say.
Yeah.
I mean, again, just talk about the internet, which is probably one of the, most
impactful.
Yes, impactful technologies. I mean, how long was the internet like being driven by porn before like everything else caught up, right?
Well, yeah, we just talked about the fact that porn drove a lot of the technological advances in the internet.
Yeah. I mean, porn basically drove the internet for a while. So, but there's a basic human need there, right? I mean, and I guess my point is that crypto has yet to identify that basic human need.
Totally agree. Yeah. And look, and I think there's going to have to be some breakthroughs of simplified versions of what we're all playing with into the real world. We talk about this all the time. So absolutely agree.
Yeah.
In terms of kind of where you're, there's a lot of talk that we are heading into a recession. In terms of what you're seeing in the market, do you feel like we're kind of heading into a really significant downturn? I'm not asking for a hardcore prediction.
I don't know. I mean, define a recession as 5 quarters of negative growth. I mean, we clearly aren't there. Like I said, our problem is not negative growth at this point. Right. Our problem is too much growth, right?
Right.
So, and that, I mean, that's not a bad problem to have in the bigger scheme of things, right? I mean, unemployment of 3% is not a bad place to be, right? You're like, oh man, everybody's got a job. So
So stop spending that paycheck money on food and healthcare. You're killing us, Matt.
Yeah, I know, exactly. It was so much better 2 years ago when like everybody was getting paid not to work. That was like,
Yeah.
socialist utopia. Yeah. So I don't know. I'm not terribly pessimistic. I mean, economics by its nature is a what do they call it, the dismal science. But I don't think I'm not that pessimistic. I mean, there's a lot of headwinds out there. I mean, the global situation, security situation sucks. Damn Russians fucking it up for the rest of us. But no, I don't think I'm not chicken littling it this time.
Mm-hmm.
Cool. Yeah. Our buddy Chuck says, I think the porn analogy breaks for people who were involved in early internet the same way that traditional finances view breaks for current DeFi. Normies saw porn as the driver, but it was online commerce. Normies see crypto as store of value, but it's already far more than that. Yeah, I think exposing that is basically what we're saying here. It's like we see, we're in making the sausage right now as users, and I think that's a good analogy to say that it was actually, I mean, there was tech driving, being able to stream video and hold lots of video and images up for porn that actually enabled a lot more to happen in the commerce sector, but ultimately it was about being able to pay for it. And I agree with that to some extent.
Yeah, but recall that pay for app came out of porn.
Absolutely. Totally agree. And I think he's right. I think this is a communication problem, and it's a adaptability, a user experience problem that we're not close to solving yet. I think we have a good chunk of ways to go on that. So I agree.
Yeah,
I agree.
Yeah. All right. Hey, good talking to you guys.
Thanks so much, Gavin. It was awesome to meet you, man.
Yeah,
you too. You too.
Appreciate it. Have a great day.
All right. Go save the world for us. Okay.
Yeah.
Later.
Right, bye-bye. Cheers.
Good stuff.
Yeah, he's a good guy, man. I've known him for a long time.
Well, if he tolerates you, he must be a saint.
Back in our younger years when we were just ripping through DC in our 20s, and I won't tell the stories, of course, because I think we'd probably get arrested for half the stuff we did back then today. It was a gang of a group of about 6 to 8 guys from, all over the country and say Europe as well. And we just would roll through a lot of fun. Let's put it that way.
Just happy there were no smartphones like, poor
no
digital Cawthorn's going through.
Yeah, no digital capture mode back then, and no 9/11 security. So we used to run around on bikes in the tunnels underneath the Capitol. All our friends on the Hill or in different government buildings. I remember being at an inauguration actually with Gavin and his girlfriend then, and his badge we could walk in the street with everybody, just cross the street, and all the machine gunned up people would just look and show his badge, and they just
nice.
We have beers in our hands and shit. It was just insane, but a long time ago. Unfortunately, now everybody's so serious.
Yeah, absolutely.
But one of the things I think we got to go, right? We're almost to one. Yeah.
Yep. But no, I think that's great insights. And I love from the perspective of the economic stuff, love hearing that because my knowledge is shit. But number two, I also love getting that perspective of someone outside of our world on their impressions. And here's the cool thing, right? Somebody like him would have probably said 2 years ago, they would not have said it's here to stay. They would have said, probably a flash in the pan. Right. And this shit's not going to last. Right. So, and I'm not saying that's what Gavin would have said, but generally that sentiment in that world would have probably been that. So we've really turned a big corner, I think, from that perspective, that people are like, yeah, it's here to stay and store of value and, all that good shit. I just haven't seen the apps yet, but that's because they're not going to dive into the apps. It's just too much. Right. And it's crazy and complex. So,
well, it's that. And also, where we see the APY numbers, remember, they're not at the levels that they were, say, last year, 30 trillion% or whatever. But we look at that as, in the past, we'd say, oh, let's front run the Ponzi scheme, basically.
Right.
Because it can't, I'm just joking with that word, but we know it can't last. So you go in for a couple hours, you bail. Well, now you see stuff like all over the place, 15 to 60%. But still, to the TradeFi person, that just looks like a scam to them.
Yeah, of course.
Because they're thinking of it in through their context. So, the fact that they're even saying it's here, because I know the people he hangs with and talks to, and it's all very, very smart economics and finance types, mainly public sector and, say NGO level stuff, non-government organizations, think tanks, but also, top people at top investment banks.
Yep.
So the fact that they're now saying it's here to stay, that tells me that there's a tremendous amount of stuff going on in these investment banks and hedge funds that we're only seeing the tip of the iceberg on.
Yep.
So I think it's all good for crypto. I just want to see how we hold up. But I also like the fact that, he's doubtful on a recession call. So which is kind of the way I've felt,
That's
for
good.
a long time. So doesn't mean that stock market won't sell off 30%.
Right.
But that doesn't mean that it's going to, tank employment and drive us into negative GDP growth for that extended period of time either.
Right.
So I feel pretty good about everything.
Yeah, man, me too. All right. Listen, folks, we will not be here tomorrow. Joe, at least, is going to be hanging out with a bunch of filthy rich people, and I may be joining him. Still trying to navigate that. And we'll be back on Monday. So
yeah. Heading off to the Bloomberg Power Players Conference tomorrow.
That's awesome.
Here at the beach. And I was at the last one was before the pandemic, and got in there, and it's a lot of fun. There's a lot of heavy hitters there. But I hope you can make it, Brad.
I'm going to try, Joe.
Yeah,
I'm working on that currently.
And if you need a ride or something like that, I'm happy to.
Where is it, on the beach or is it downtown?
Yeah, it's beach. Equinox Hotel. I know. You can come park in my neighborhood if you want. And
maybe we'll do that. Yeah,
something like that.
Let me see if I can navigate it. I'll let you know later today.
Hit that link. Just make sure it's still working. Okay.
Yeah. Hey, everybody. Thank you so much for joining us. We love you. We appreciate you. Please let your friends know, rate and review us on Apple Podcasts. Also subscribe and click the little bell on YouTube. We appreciate you being here. And if you have any projects, ideas, or thoughts, please don't hesitate to DM me, B05 Crypto, Twitter, and Telegram. Always happy to chat. So thanks a lot, Joe. Have a great day.
You too, buddy. Thanks, everyone.